There we go. So hopefully, if people that can't make it can at least watch what we're doing and play it back like a video.
Right, that'd be
Okay.
great.
I am going to try to give you a real basic overview of some things about accounting, and then we'll tie it together with what you're learning. So you may hear things that you didn't see in your book, and that's okay. It doesn't mean that these things are going to be tested. I'm just going to kind of give you the whole big picture.
Okay.
So one of the things we're going to talk about is what a company has. So we're going to pretend we're really simple. I'm not going to start with a manufacturer because their accounting is probably the most complex of any kind of business. A merchandiser that sells a product is somewhat complicated, and we'll transition to that in a little bit, but we're going to start out with just a service business, somebody who does a service. So maybe we do something like house cleaning. I can't type for the life of me tonight. Okay, so we're going to do house cleaning, and we're going to imagine that business and what its financial statements would look like.
Okay.
One of the things that they talk about in your chapter, and you'll see in financial statements, are assets. And most of the time students understand what they are, but if you read the official definition, it actually sounds like a lawyer got involved. It's
Right.
complicated, but the concept is really simple. It's all the things that the business owns. Now, what it isn't is things that it rents. So I'm going to take that and see if I can make sense. I wish I could draw that little circle with the straight through, but this is what I'm going to do. So not things that they rent. So if the business has no physical building, but they use some office space in a strip mall that they decide just to sign a lease and buy so many months of rent of that office space, then you won't see a building listed on their financial statements because they don't own it. But they do get a chance to list the building even if they've got a mortgage on their building. Just like when we're filling out an application, it might say, do you rent or do you own your own home? Well, most of us don't own the home. Even if we have a mortgage on it, it's the bank that owns it, and we're just making payments, and someday we'll own it free and clear. The business can do the same thing. They can list it as an asset even if they're still making payments on it. So what I want to do is just kind of take our list here and think of things that this house cleaning business would own. So just kind of in your mind, imagine our house cleaning business. What kind of assets do you think they'd have?
Vacuum cleaners.
Sure.
Brooms and mops.
Yeah. Sharon, I don't know if I heard you correctly, but is that what you said? Mops?
Yes, mops and brooms.
Okay.
They're going to need something to drive.
Right.
To get to their location.
This gets a little complicated only in the aspect of if it's really small, it might be this husband and wife own a house cleaning business and they have this minivan they drive their kids around in, but they also go to the jobs with.
Yeah.
That would make the accounting kind of complicated because officially our business's financial statement should only include things that belong to the business, and the personal life should be separate from that. So we're going to assume that our vehicle is strictly for the use of the business, just eliminating that complication.
What else?
Just making a note here. I'll be with you in just a second, so have a chance to brainstorm.
They might own, and I'm not sure what they call that thing that shines the linoleum floors or whatever.
Oh, yeah, like a floor cleaner.
Yes, I'm not sure what that thing is called, but they might have one of those.
Floor waxer.
Yeah,
Sure.
there you go.
Give it some kind of fancy name. I'm going to get you started in a little different manner. If
Okay.
they have an office, they might have office equipment. Might be a computer, fax machine, a phone system, different things in the office.
Okay.
If they have an office, they might have furniture. Depending on whether they have the building or whether they rent the building, we can give them a building. Maybe they're actually buying a building.
Mm-hmm.
They're going to have some
So
supplies.
would we be looking at maybe their computer system?
Yeah. Let's give them some office supplies. And they're going to have, most of the time, these things are kept separate because they're so different. But a lot of times in our story problems, we just may see supplies and it doesn't get specific.
Okay.
Of what kind, but we can be as specific or as lumped together as we want in a problem like this.
What about their computer system?
Oh, okay. Yeah, there's a few more things that you may not have necessarily thought of that, because these that we've been naming are tangible things. We could literally walk around and see them and touch them.
Right.
But there's other things that they have, like their cash. So in a financial statement, you'd see cash. Cash, in this case, actually means the checking account, the savings account, the literal cash in the desk drawer, all those kinds of things just lumped together in one category called cash.
Okay.
So it means that it's available to spend. If they could somehow spend it, whether they use a debit card or whatever, it's liquid in financial terms, just meaning it's available to spend.
Okay.
Another thing that you're going to see is an accounting term called accounts receivable.
Mm-hmm.
And that just means customers who owe them money. So if they have a cleaning business, they probably have an established relationship with their clients. So maybe this certain business they clean every Tuesday night. And at the end of the month, the business they work for, their client, writes them a check. So during the month, they have this account with a client that keeps piling up, and the client owes one Tuesday, 2 Tuesdays. Pretty soon there's all 4 Tuesdays waiting to be paid by the client. So we would keep a record of all that's owed to us and call it our accounts receivable. Okay? So it's all the accounts or clients who owe us money, and a total of all of them. It may be a really sophisticated record-keeping system. It may be a calendar where they just write down which job they did and how much it was for. But hopefully there's some way in the business that if we walked in and asked them, who owes you money and how much do they owe you, they have some way of telling us. They probably have insurance. Okay. They're going inside all those other people's houses and businesses, and they're going to have insurance that they don't break anything. They'll have insurance on the vehicle they're driving, on the building that they own. So insurance policies go here as long as they haven't been used up. So when we buy an insurance policy, usually buy it and then it covers you for the next 6 months. We call that prepaid insurance because you paid for it in advance. And it sits there on your list of assets until it's used up. But as it gets used up, it gets taken off of there until you buy another insurance policy, and then it goes right back on. So it's something that's shrinking over time until you buy the next chunk of insurance, and then it goes back up to being a bigger balance. So those are some of our biggest assets. We lumped a lot of things together. Like mops and brooms, we could have separated them. Businesses are real concerned about how many assets they have, but they don't sit around and go 1, 2, 3, 4, 5, 6. I have 15 assets. How many do you have? They talk about it in terms of dollars. And they'll total this up and say, I've got $100,000 of assets, and compare themselves that way. So whenever somebody wants to see a report about the business, they're going to ask for a list of the assets, and they don't want just the names of the assets. They want a dollar amount beside each one.
Okay.
And in your reading, you probably saw that the dollar amount is supposed to be the cost of the item. So with the vacuum cleaners, we'd put it down for what they cost us. I'm just going to make some numbers up. There's no way I would know, but I am not going to put down small little things that are going to make it no fun to add up, even though I'm going to have Excel do it. Just nice round numbers. Now you're probably wondering why I would have, sorry, I'm just going to put some commas in this. These things at their cost when the vehicle, if they've had it a couple years, isn't a $40,000 vehicle anymore. It's gotten wear and tear and, as much as anybody, the vehicles, when you buy them, are this big high price, but after a year, nobody wants to pay that amount for your 1-year-old car. It goes down a lot in value. So actually, these things will eventually be shown with depreciation. So we're going to show depreciation. So we will actually show that number a little lower than its cost over time. The same thing with the smaller things, the vacuum, the racks, or the office equipment. We'll show them going down in value. But for the sake of our discussion right now, I'm not getting into the complication of depreciation. So just understand that I do recognize that this is kind of overstating some of these numbers. I'm treating them kind of like they're all brand new. Mm-hmm. And everything we put down at what we paid for it. Or if it's cash, we just look at the balance in the checking account and put the number down. Mm-hmm. So let's say they've got some money in the checking account. Accounts receivable, hopefully they've got even a calendar or something so they know who owes them money. And all the rest of these, they can look up and find out what they paid for them. And then they'll come down and make a total. Can you see everything I'm doing on the screen if I roll too far down?
Yeah.
Nope, you're looking good.
Okay. I'm going to pretend that whole list of assets came to $500,000. So I'm making that number up. And then the person who wants to see these financial statements, maybe it's the bank and we going in asking for a loan. The bank wanted to see, what do you have? What are your assets? The bank's going to ask about another thing now. I'm going to scroll down farther. They're going to want to know about our liabilities, which again is another big fancy accounting word for a simple concept. It's what we owe. So the bank wants to know, what other debts do you have that you've got to take care of? Because they're going to loan you money. They want to make sure you can pay that money back. Mm-hmm. And if you already owe 20 other places a whole lot of money, they know they're just going to be the 21st place that you owe money to, and you may not get around to paying them. So we're going to list all the assets or all the liabilities that we have. And one of the things that we need to think about is we only list the things that we owe today. And that's kind of a tricky way to say it. It doesn't mean the due date is today. But as of today, I owe it. So one of the things our company would have, because we have a building, we have a mortgage.
Right.
Even though we've got an arrangement with the bank to pay them back each month a certain amount of money, we legally have a debt today for quite a large amount of money. Let's say $150,000. I don't know if Excel doing it. There you go. And we might have smaller bills like the company credit card that we owe. We might have utility bills that we haven't paid. Those would only be listed if we've used the electricity or whatever the utility is, gotten the bill, but haven't paid the bill. So kind of imagine somebody's inbox on their desk where they throw all the mail and I'll get to it eventually. And it's sitting waiting to be paid. Just knowing that we're going to have a utility bill in 2 months. In June, I'm going to have a utility bill. Yeah, but that's not going here now because we haven't incurred any obligation to that. We didn't use any electricity yet that we would be paying for in June. So hypothetically, we could never use electricity, shut it off before then, and there won't be anything. So this is only going to list the things that are due or that we're legally obligated today. We have the cell phone bill, again, the same way as the utilities. We might have suppliers that we have arrangements with, send us another case of cleaning solution, and they send it to us, and then we wait and pay them back in a few weeks after we get the bill. A lot of these little things are going to be lumped together. I'm going to move this over so I can show you. These guys all together would be lumped together and called accounts payable. It's a common way, instead of showing every stinking little bill that the company has on a financial statement, they will generally just throw them together in a category. Just like we didn't list every customer who owed us money, we threw them together and put them in a group called accounts receivable. We did the same thing with our little bills and put them together and just said accounts payable. And then we would show the amount. Make some kind of sense?
Yep.
Okay.
I'm with you.
Plenty more liabilities that could show up here. But once you learn what a liability is, no matter what else you've got going on, it follows the same rule. So if we total those guys up, we have $175,000 of total liabilities.
Okay, you have to back up real quick
Okay.
and show me how you just added those together
You want me to go into my Excel mode?
very quickly.
That's no problem. I'm putting my cursor where I want the answer to go. I'm actually going to delete my answer to go back over it with you. So you can see by the little border around the cell that that's where my mouse is at right now.
Mm-hmm.
Then at the top right-hand side, there's a sigma or sideways M Greek symbol. And it says auto sum. If I click that, Excel says, what would you like to total up? Well, it looked left, right, down, up, and said, well, there's not a lot of numbers around. I'm guessing it has something to do with that 25,000. But Excel doesn't know how to get beyond blank space. It stopped because it thought that was the edge of the universe. There was nothing else around.
Got it.
You have to grab the border here,
Pull it up.
on the side, and drag up. And
Got it.
I want you to add everything within this rectangle. So I've taken that out farther, to as far as I want it to go.
Good. Thank you.
You're welcome. The other way I could have done that, and I'll do it down here, is I could have said equals. That's the way to tell Excel, hey, I'm about ready to do a math problem. And go click the number that I want to add, hit the plus sign, click the next number, and now I've got add those two cells together. I hit enter, and it does the problem.
That's the way I'm used to doing it. So when you did it so fast, I'm like, okay, what did she just do?
Yep. And it works better because if I were to put a number in one of these, because on our rectangle included everything up to above the mortgage, it would have automatically put that number in my total.
Got it.
Where the other one just specifically said, add those two things together. So now, to kind of recap, I have assets in our company of $500,000 and liabilities of $175,000. So if the bank was worried, they could see that we could take those assets and we'd have plenty of money. If we liquidated them, had a garage sale, whatever, turned those into cash, paid off all the bills, there would be money left over. No, it's not the accounting term for it, but we call it the leftovers to kind of get that discussion going. And 500,000 minus 175 means I have 325,000 left over.
Now, how did you put that minus in there?
Okay, I'm going to go back. Equal tells them I'm going to do a problem. 500,000, and then you either want to use, I have a 10 key that's on the side of my keyboard, but if you don't have that, up where you have the numbers across the top, you have a button that puts like an underline, what do they call it, underscore, and it has a minus. You want the one that you don't have to hit shift for, just that button. And then the next field. There you go.
Oh, okay.
So who does that 325,000 belong to?
Us.
Yeah, since we're a partnership or a sole proprietorship in this case, this one person owns it. If it was a partnership, that would belong to the partners. How they split it is kind of up to what they've agreed to. There's no set in stone rule about how partners need to share that. They may have decided that one works in the business so much more than the other one that that other one should get more of that. That's something you can't figure out. It has to be, you have to have knowledge of their agreement to know what they're supposed to do with that. And if this is a corporation, this is called the stockholders' equity. It belongs to the stockholders.
Got it.
But if since we're staying with a little simple business, this is going to get called, not the leftovers, but I'll put a better title above it, owners' equity.
Oh, okay. I thought it would have just been called the profit.
I'm sorry?
I thought it would have just been called a profit.
No, actually, this is not the profit. So we'll get to profit in a couple minutes.
Okay.
So we have seen what we call an accounting equation. It's assets equal, or assets minus liabilities, just what I did, equals owner's equity.
Gotcha.
That's what we just did. But the most common way you're going to see it is assets equal liabilities plus owner's equity. I pulled some algebra out on you there. It means the same thing. So let's take a look at it. In our case, that's 500,000 for the assets equals the liabilities plus the equity. So these two guys together, yeah, they do equal the assets. So it's another way of saying exactly the same thing. That is called the accounting equation, or called, because that's what a balance sheet shows you. It shows you assets, liabilities, and equity for a business. And I am turning my attention. I have your textbook open on a second screen. I'm going to try to find us a page that actually shows us a balance sheet. And there we go. It's telling me that it's page 31 of the textbook. And I want to share our screen and take you over there. So if you don't have your textbook, don't worry. It's just going to take me a second to get to it. Are you able to see this balance sheet now? I mean, it may be a little small, but.
Yep.
Okay. Let's see if I can blow it up size-wise for us a little bit.
Well, I've got my textbook.
Okay, it's on page 31 of the textbook in chapter 2. And another title for balance sheet is a statement of financial position. So if you're ever looking through a company's financial statements and you're like trying to find what page the balance sheet's on, it may be that they called the balance sheet by this other name. A balance sheet is always for a particular date. It's never for the whole month of December or for the whole year of 2010. Because just like we did up above in the Excel, we stopped and said, what does this business own and owe today? So it's always at a moment in time, a certain date. And this has a whole lot more in its balance sheet than our little simple company. So I'm going to try to show you what's here and make sense of it a little bit. The black heading here says assets. If you scroll to the next black heading, it says liabilities and equity. In this case, stockholders' equity, because they're fancy and they have a corporation. But the liabilities are in pink and the equity is in black. If we go back up and look at our assets, we'll see that the assets, when they were all done with listing all of them, it came to $1 million. Then they listed their liabilities, and altogether their liabilities were $300,000. And we know that if you take your assets and you minus your liabilities, it would leave leftovers that would belong to the owners. So the owner's equity is $700,000. The leftovers after the liabilities would be paid. So the same accounting equations going on here that we just played with. That makes some kind of sense?
Yep, sure does.
Okay. Now let's get into why theirs looks a little different than the things we were talking about. They actually took the list of assets, instead of just making this master list, they organized them. They subcategorized them. They grabbed a few and said they're called current assets. These are things that they're going to use up or turn into cash within the next year. So for us, our office supplies, our cleaning supplies, they're probably not going to hang around for a long time. We're going to use them up and replace them. They're short-term things. Our accounts receivable, we say that we're going to collect that money within a year, so it would go up here. Marketable securities is when the company has enough money in their checking account that they can afford to stash some of it in investments, like call their broker and say, buy me a few shares of the stock or get me a CD at the bank. That's what this company has done. They have some money stuck away in some investments, but they're marketable. It means they're short-term investments, like a 6-month CD. Because remember, to be in this category, it has to be something that's going to be done within a year. Then there's other assets, and that's longer term. So there's more investments, but these are long-term things. Maybe we bought a second piece of property. We have the property that our facility's in. We have a factory or an office and a building. It sits on a piece of land, but we bought another piece of land in another part of the city just as kind of a good real estate investment. They would put that in this area because it's not something they're using to do their business. It was bought strictly to make money on. Then the last category is fixed assets. These are just the big things that are going to last a long time. Our vehicle would go here, our building, the equipment we use to do our business. And you'll see that they do reduce it. This is telling us that those things originally cost $1,100,000, but they've been slowly reducing that because they're getting older. So they're taking away $600,000. So now they're showing those same pieces of equipment and factory at $500,000 because that's a more accurate representation of what's left of the equipment. It's gone down since we bought it.
Okay.
So that's our assets. Liabilities categories are much easier. You can see that they're broken into two, current and long-term. And the 1-year rule applies here. These are the bills that you're going to need to pay in the next year. And this one doesn't get paid for several years. Now, I know it says 2015, but if you remember, this balance sheet was for 2010. So for them in 2010, 2015 seems a long way away. So they put it in the long term. So if it's more than a year before you're going to pay it, it goes down in the long term. If it's something that's going to be paid in the next year, it goes in current. Otherwise, it's just a list of all their debts. Stockholders' equity, I wouldn't worry a whole lot about of understanding the whole things that you're seeing here yet. But understand that this represents the equity that belongs to the owner. It's grouped into two categories. One being the, there we go. The top, they didn't total. I'm surprised. These three numbers, they don't show a total for, but 50 plus 100 plus 4 plus 250 makes $400,000. So the stockholders' equity is $400,000 for these three, preferred stock and common stock and this other one. That all represents money that people invested in the business. So when stockholders decided they wanted to join our business and become an owner, they gave us a grand total of $400,000. So we say that is from the owners. That's paid into the business. Where the retained earnings, this $300,000, is all the profits they've made over the years that they're holding on to or retaining. And the only way retained earnings goes down is when we decide to give some of that money out to the owners. The profits have been piling up year after year. They go in this account, and the board of directors says, let's share that with all the stockholders. Let's mail everybody a dividend check. Then it would take the retained earnings account down. So all we know is that right now there's $300,000 in it. There might have been more in that over the past few years, but then dividends were paid, so it went back down.
Now, is that for the total stockholders amount, or is that per stockholder?
No, that is the total. So all the
the
stockholders would share that. So if there's 100,000 shareholders, each one would get about $7. They have about a $7 amount in the business.
Okay.
So we'd have to kind of divide that by how many shareholders there are to get a sense of everybody's share of the business.
Gotcha. Okay.
Okay, so that's a balance sheet. I'm going to take us back, and we're going to look at our Excel worksheet for a minute, and then we'll come back and look at an income statement. Yeah, getting us a new sheet, so we have fresh piece of paper to work with. And when a company, we did a balance sheet, that's a moment in time. That was just a list of what we had on that particular day. But every one of those numbers is going to change. A customer's going to pay us. We're going to go do another job for somebody. We're going to buy some more supplies. We're going to pay a bill. All those things make all those numbers go up and down. Cash, you think about what happens in your own checking account in a week's time, how many things go in and out of there. Well, it happens in the company. So they have to have a way of keeping track of what's happening in every one of those accounts. So one of the simplest ways we show students is that you have your different assets. Just abbreviating, so if you don't understand what I wrote, just let me know. Let's do, I'm going to sneak another one in there. Just trying to come up with a few so you can get the idea, but not so many that it gets cumbersome. So let's say our company has 5 assets: cash, accounts receivable, supplies, equipment, and a building. Then we have some liabilities, and we just lump them together in accounts payable, and we'll have mortgage payable. Let's see if I can shorten that. And then we're going to have our stockholders' equity or owner's equity. So let's do owner's equity. And I'm going to shrink the size so hopefully you can see all of my columns without it getting horribly small. How's that?
Looks good.
Enough size you can see it?
Yes, ma'am.
Okay, so keep track of it. Company books are a lot more complicated than this, but they do the same thing. They would, let's say an owner decides to start the business, gives $25,000 to the business. The checking account of the business just get a whole lot more money. But it didn't create any of these other assets just by getting money. The company still has no accounts receivable, no supplies, no equipment, no building. It doesn't have any debts, though. That's really nice. Probably the only time it's never going to have any debts. So all you've got going on in the business is the owner put money in, and since there's no liabilities to pay with it, it all still belongs to the owner in his or her equity account.
Mm-hmm.
Every time we record a transaction, it has to go in at least 2 places. Because if you remember, let's see if we can, sorry, Excel doesn't like me just typing an equal sign. It thinks it wants to do a math problem. The assets have to equal the things on the other side, the liabilities and the equity. If I just put $25,000 over here and don't do anything over on the right side, it's going to be out of balance. So we're going to see as I go along, I'm always going to make sure we're in balance. So it gets money. The first thing he's going to do is go buy some supplies. Spend $1,000 on supplies and maybe $8,000 on some equipment. If he spent money, we've got to minus it out of the cash account. Okay. So you notice that I didn't go to just one place. I did 3 columns, but all I did was play over here with the assets. I didn't go to our liabilities or our equity at all. So we're going to see if we're still in balance. Cash would be 16,000. Supplies and equipment would be just the balance that they are there. 1,000 and 8,000. And that's all we have for assets. 16 plus 1 plus 8. You add those up, that's 25,000.
Okay.
Same thing we've got over here. We have 25,000 on the right side of the equal sign, so we're still balanced. So we don't need to go to both sides of the equal sign to make things balance. Sometimes it's just a shuffling. If you kind of picture two scales, and this side we had all apples, and over here we had a can of fruit. We could take an apple off and put on an orange and maybe not change the total weight of that side of the scale. So we took it off. It had been all cash, and now we kind of changed it to being some cash, some supplies, and some equipment, but the grand total's the same. Another thing that company will do is sometimes when they have a big piece of equipment or a building or something to buy, they'll make a down payment. They'll put a small amount down and pay the rest later. So if we have a $20,000 piece of equipment that we're going to buy, maybe we'll put a $1,000 down payment on it. I forgot my minus sign. Well, that's not going to balance. Go over here and show that I have a $19,000 debt.
All right.
And now it's going to balance. And I could stop and subtotal like I did here every time, but I'm kind of watching for us to make sure that we're balancing. I just thought I shaded that to make sure that you could see that those were just subtotals. That the numbers that we're actually doing are here, and this is just a subtotal. And we would keep recording everything that happened. So a company has a cash account. We call it our column because we're in a really unsophisticated way of keeping accounting records. And we just record all the pluses and all the minuses to cash in this column. And if we want a total, we just stop and subtotal it. But accountants will use a general ledger system. You've heard that term probably at work, and somebody's talking about the general ledger. It is just a place to keep track of everything that happened with each one of these accounts. And they will debit and credit each of the accounts. So I'm going to show you what they mean when they talk about debiting and crediting.
I think I've heard them referenced as GL accounts.
Right.
Is that
now? It's all they're saying is general ledger, but they're trying to be cute and use shorthand and not have to say general ledger.
Got it.
But yeah, it's just like the computer industry. I like to knock computer people. My son is really techie, and they have their own language. And sometimes if you understand what they're really saying, it's not all that sophisticated. But if you hear it only as their little acronyms, it sounds all confusing. It's all initials or words for things. Okay, when they first teach students debits and credits, they take that column that we have here and turn it into what's called a T account. No, it's not too hard to see why it's called a T account. Looks like a capital T. They put the name of the account up here, and then they have a side where they record every increase. So if you want to increase cash, you're going to record it on one side. So I'm going to call it the plus side. And I'll call this the side where they do the minusing. So they record their increases on the left side, their decreases on the right side. So if we go back up to our transactions, we had a $25,000 thing that happened to cash that was positive. But then we had a $9,000 thing that was negative and a $1,000 thing that was negative. So that's how they would record it in the cash account, kind of sorting out the positives and the negatives. They don't need to show 9 and 1 as negative numbers because just by the fact that they're on that side, everybody knows that means they're being subtracted. somebody would stop and subtotal and they could say, oh, okay, there's $15,000 left now. And they might have a place for balance and show the balance in that account. It's not a real sophisticated way to show it, but accountants use these a lot as they're trying to sort out the books of the business. They might grab some scrap paper and write this out. Just like your kids will show you a long division problem. No adult writes out a long division problem at work. We all do division through a calculator, but to teach a child to understand division, we show them the whole long division symbol and make them work it out. So where do those crappy words debit and credit come in? They confuse more people. Debit looks like the word debt. It kind of sounds like a bad thing. And credit, we use it a lot in our English language as a good thing. You have a credit rating. You're going to get credit for taking this class. Somebody gave you credit for the great idea at work. So there's all these positive things associated with the word credit, and debit just kind of sounds like dead, and it doesn't sound good. So people get in their head that they mean good and bad, or increase and decrease, or all these things they want to attribute to them, but they actually come from the Latin words for left and right. That's all they mean. And while you can't see me writing like you would in a physical classroom, I am debit-handed. That means I'm left-handed. And a lot of people are credit-handed. That's all those words mean.
Okay.
We come into accounting class with so much in our brains that's telling us those words mean other things that it confuses students. So when you look at the cash account, we say that entries on the left side are debits, and entries on the right side are credits. So they would say words like, we just debited cash $25,000. That just means I put an entry on the left side of cash for $25,000. Or I credited cash for these other amounts. The problem comes in, and I am not going to teach you an overall, make you experts at debits and credits because you don't need it for this class, but you do need a little bit of an understanding. So that's kind of what I'm trying to do, is just a real basic overview. Okay, so I'm drawing another T account, and we're going to make this one a different one, accounts payable. Because remember, every column in our chart up above would be replaced with one of these T's.
Okay.
And bear with me as I move a few things over here. Now, here's my complication. Accounts payable has a side where it records all the times that it increases, and it has a side where it records all its decreases. But did you notice they're flip-flopped from the way cash was?
Right.
Mm-hmm.
That's what gets confusing to students. This is still the debit side, and this is still the credit side. But when I am referring to debiting accounts payable, I said, we just debited accounts payable $20,000. I am saying that I decreased it. If I said I credited accounts payable $20,000, I'm saying I increased it.
Okay.
But if I was to debit cash, I would be increasing cash. So tying debit and credit to increase and decrease is dependent on a kind of account. So accounting is really just a matter of putting numbers into categories, keeping track of what happened to cash by increasing or decreasing the cash and the liabilities and all these other accounts. And those words just refer to what you're doing to it. Well, that's as far as I think you probably need to go with debits and credits. If something comes up that we need a lot more, we'll talk about it more. What I want to do is just have you realize that someone's got to be keeping track of every time money comes in or out and things happen in our business. Somebody's got to keep these things up to date.
Mm-hmm.
Because it's going to be time to make the next balance sheet, And they're going to say, well, at the end of the month, how much cash was there? Because I need to put cash on my balance sheet. How much is owed to me from customers? And so filling out the next balance sheet, they're going to need to fill in with the bottom of the statements, numbers. So whether it's a sophisticated computer program that records these and can spit out the balance, but every entry has to be put in some way. The other financial statement that we're going to see is the income statement. An income statement covers a period of time. So it'll say things like, for the year of 2015. So it means this is a summary of a bunch of stuff that happened in 2015. It could be for a small period of time as a week. It could be a month, a quarter, a year. The period of time can be anything you want it to be, but it never represents just a moment in time. It tells us about two things in our business: our revenues and our expenses. It subtracts them, and the answer becomes our net income. Net income has lots of names. Most of you think of it as profit, sometimes called our bottom line, because it's usually the bottom line of the statement. They'll to show the revenues, they'll show the expenses, they'll subtract the two and come to the bottom line. And hopefully that bottom line is a nice, big, positive number. It used to be long ago that when you were typing or using an adding machine and you needed to make a negative number, there was a ribbon in the typewriter. I know, I'm telling them how old I am. And the ribbon had two colors. It had black and a red.
Mm-hmm.
And when a number was negative, it was done in red ink. And if the number was positive, it was black ink. So it became the phrase to say, are you in the black or in the red? It meant what color ink got used at the bottom line of your statement. Was it a good thing, you know, positive black number, or was it a negative bad number and it was in the red? So if you ever hear those terms, that's all they're talking about, is how did the final number on your income statement come out? Okay, so let's back up and talk about what revenue is. Revenue is work done for clients or products sold. Right. So for a service business, like doing cleaning for a client, our revenue would be all the cleaning that we did in this period of time. What gets a little complicated for people is that you can do all the work and not get the money yet. So if we're doing a list of all the revenue in 2015, we probably did lots of jobs for lots of clients. We total up all the money that we earned during that time. I'm going to shove this over just a hair and put an amount here. Let's say we did $450,000 of cleaning jobs.
Woohoo!
Yeah, hey, we want to make a profit in this business. Because in textbook land, I can make the numbers anything I want them to be. Might as well make them good. Okay, so if we did that work, there's no guarantee that our checking account has seen all that money. Remember, we let our customers sometimes pay us at the end of the month or make arrangements to pay us later. So looking at the income statement, I can see great numbers here in revenue, but I could still have a really bad problem paying my bills. If customers are slow paying me, then my checking account's not getting money in it, and yet I still have bills to pay. I have probably employees that work for me that need a paycheck. So a company can be really having trouble, but yet have great revenue. Because those two don't necessarily mean the same thing. This should all turn into money in our checking account at some point. The problem is, how quickly is it going to turn into money? Expenses are all the things we, I'll move over here, use up in the process of doing our work. So if we use up utilities to do the work, if we use up cleaning supplies, if we use up our employees' time, the amount we pay our employees, those will be expenses. And generally on our income statement, I think what I'm going to do is do this. I'm just going to drag this down, and what you'll see on the income statement is a title that says expenses. But it won't have a number with it. It will have things listed below it, such as supplies expense, wages for our employees. So we'll list all different types of expenses. The other things that we mentioned, supplies, wages, utilities, anything else that we might have had. And so you'll see a listing of the expenses and then a total of all the expenses. And let's say our total expenses are $300,000. Just a second. I got to take a break for just a second. I'll be right back with you.
Fun.
Okay, I'm back. And the revenues minus the expenses would give us our profit. So I'll move our bottom line out of the way here and we'll come up with our answer. We made $150,000 of profit.
Wahoo!
That's a very simplified income statement. That's all it's trying to tell us is the work or the products that we sold. If this was a merchandiser, our revenue would say sales. So this heading here would say sales instead of revenue. And this would be the amount we charged our customers for the product. And one of the expenses would be our cost of the product. And we can look at one of those in a couple minutes. But for a service business, this is really all there is. I'm peeking back at our textbook to see if we can find an income statement. Okay. Just a couple pages away from where we were looking at the balance sheet. And our income statement here is still a little more complicated than we've gotten to.
Right.
Let's see if we can scroll down on our Excel spreadsheet and I'll show you what I'm talking about. Our revenues for a merchandising business are sales. And for the textbook problem, they have it as $2 million of sales. That's the price we charged our customers. So we might buy the stuff for $800,000. And then we put price tags on it and we charge a whole lot more than that for the products.
What page are you looking at?
I am looking at page, I think it's 27. Yep. It's just a couple pages back from the balance sheet we were looking at.
Okay.
For a merchandiser, I want to make sure we put these notes up here for those that are watching later. We're doing somebody who actually sells a product is going to have their revenue be their sales. And the very first expense they're going to list is going to be listed all by itself, not with all the other expenses. And it gets the title Cost of Goods Sold. That's kind of a fancy way of saying, what did it cost us when we bought those things that we just sold? We sold them for $2 million, but according to page 27, they cost us $150,000 when we bought them. And there we go. So that means that just in the markup from what it cost us to what we charged people, we made a profit of $500,000. But unfortunately, we don't just get to keep that profit. In class, I usually use an analogy of some kids running a snack stand at the soccer game or the basketball games. And their revenue, of course, is all the little snacks that they sell. Their cost of goods sold is whatever they paid at Sam's Club for the box of snacks. And then they get to make a profit. But they have to pay some expenses. And in our silly example, I make them pay mom back for the gas to drive them to Sam's Club and any other little, and they have napkins that they offer for their customers. So we come up with a few silly expenses. But in the problems in the textbook, you're going to see some categories of expenses. Instead of just listing them all, they might just list operating expenses, or in this case, selling and administrative expenses. That's a big, broad category of a bunch of expenses. Could be commissions paid to the salespeople, advertising, paying for the president's salary in the administration building, all kinds of different expenses lumped together. They said those totaled $270,000. So we had $500,000 in profit for a while. This is showing us that it's getting taken away because of expenses and depreciation. When our assets are dropping in value, that's another cost that hurt us this time. That's another $50,000. So now after we take those guys away, what's left over is called operating profit. So we're going to start with our $500,000 and take away the two expenses. And now this is what we have. And our income statement in the textbook goes on farther. It shows paying some interest, paying some taxes. If you're a corporation, there's more subtractions here.
Mm-hmm.
They'll be taking away interest, taxes, etc. And if there are any of those things, then the profits will be a new number. They'll finally get down to net income. They're going to call it earnings after taxes. If this company had any, otherwise they would just bring down the $180,000. So let's say that they don't have any, and then their profits would be the $180,000. So an income statement is trying to tell us if we have a profit. How the two statements fit together is that this net income goes over to the balance sheet and gets dumped in as equity. When the revenues were happening, most of them, well, they all ended up as assets on the balance sheet. They either came in the cash account when the customer paid, or they're still sitting in accounts receivable. So these numbers have already made it to the balance sheet. And some of these expenses took money out of our checking account, or they're bills that are still waiting to be paid. So they have affected the balance sheet already, and we will see that the balance sheet will show an increase of $180,000 in our profits or our equity. So you've had a big overview of the two financial statements. There's lots of things that people do with the financial statements. They compare things. They compare last year to this year. They look at what percentage, like how much profit out of how much revenue. Ooh, that's 1/3. They turn that into a percent and say like 33% profit margin. That just means out of every dollar of sale, 33% of it gets kept as profit. So they'll talk to you about, in chapter 3 in particular, some of the financial analysis. They're just comparing things on the financial statements, looking for, are we getting better? Are we getting worse? How does our company look compared to other companies? Let's see. Anything else that you saw in your homework that you thought, or in your reading, that I haven't covered that was really kind of confusing?
Well, I do have a question.
Sure.
I just finished the reading, but I'm trying to find where's the homework in the book.
I believe it's page 48 8. Yes. Top of page 48. You remember how it said 2-11 and 2-12?
Right.
Yes. Chapter 2, question 11 and question 12. The first number will always tell you the chapter. So you need to be at 48.
Okay.
It's actually on page 49 in the book.
49. Okay.
Okay. Mine's on 48. I'm sorry, at the top. One company starts with Stein Books, and the other is Lemon Auto Wholesaling.
Yeah.
Yeah. Okay. I was
kind of making these financial statements.
Okay.
So what was the deal about inventory in the second example? Because it said that they had more inventory, but did they make more money?
Okay. The second homework problem?
Yes.
Okay, let me kind of catch up with us and read it here. Well, you know what? We'll just switch screens and we'll go look at it together. So
they carried more inventory, but yet they made more money. So did they really make more money? What's the question?
Okay. They had sales and cost of goods sold and selling and administrative depreciation and the firm's tax rate. So compute their earnings after taxes. So you're pretty much making the income statement that we just made.
Yeah.
Then assume the firm hires this person, an efficiency expert. She suggests that increasing selling and administrative expenses to a certain percent, sales can be increased. Extra sales efforts will also reduce cost of goods sold, making better profit margin. Depreciation will remain the same. However, more automobiles will have to be carried in inventory to satisfy the customers, and interest will go up to 15,000. So do another income statement again, and will it increase profitability or not?
I see. Okay, so when we're doing homework, we're doing this homework on an Excel spreadsheet, just like you just showed us.
You can do it on Excel or in Word, but I find Excel easier when you're dealing with numbers and things.
Okay.
And then you save it and put it in the Dropbox in the unit 1, I think it is, possibly. Yeah.
Yes.
The unit 1 has the Dropbox.
Okay. And this is all due by Monday.
Yes.
Is there a specific time on Monday?
No. Midnight, until it's not Monday anymore.
Yep, done by midnight.
I have a Monday night class, so I won't even begin to look at it till Tuesday morning. And, it takes me a while to get through all of them and look at everybody. So I'd say by Tuesday night, Wednesday morning, if you're not seeing any response or grade put there, feel free to send me a message and make sure I got your stuff okay.
Okay. Now, I have another question, and I know this is not related to what we were just going over, but the project that we have to do at the end where we have to do this presentation,
Mm-hmm.
I am so totally lost as how I'm supposed to present a live presentation.
Okay, you're going to do something like this, where you'll just be able to talk to your classmates.
Oh, so I will just kind of log on to this thing right here.
Yeah, I'll show you a little bit more about it. And you can put things up on the screen because you can do what I'm doing. I'll give you the control and you'll be like the teacher. And you can put something on the screen and show them and talk. And it'll be just like you're in the room.
I see. Okay.
Okay. I'm going to get back to Chad's question here for a second. He's asking about Part B of question 12. And because you're increasing inventory, what you're doing is increasing the balance sheet.
Yes.
Just having more inventory doesn't do anything to our income statement. Now, I know the problem talks about things happening here. Because you have extra inventory, you ended up needing more warehouse space and more. So there were some extra expenses going on. And they tell you about those, and then those are going to cause the profits to be a little different, but they also increased your revenue. and decreased your cost of goods sold. So there were some great things happening up in this area because of Part B. And there were a couple of extra expenses. So you really are trying to see, did the positives that happened up here outweigh the negatives down here to make the bottom line better or worse under the new scenario?
And again, what you said was that the additional inventory would affect your balance sheet,
right?
But it wouldn't affect your income statement.
Right. Exactly.
Okay, I got it.
Good.
I don't like that. I don't like that. I got it.
Well, we're going to take this piece by piece and digest every time that we learn something. And the worst thing you can do is let it go a couple of weeks and say, oh, I never did get week 1. I'll just move on to week 2. It builds on it.
Right.
So we can do this as frequently as you need and just go over concepts or exchange quick messages. And sometimes it can be solved through a couple of texts or an email, but there are times when we just need to look at the same thing at the same time and work it through step by step.
All right, I'm good.
Okay. How you doing? You okay, Sharon?
I think I'm going to be okay.
Okay. Well, remember, I'm doing this exact same thing tomorrow morning. I will send you the file that we just created. And if you find yourself wanting to join us again in the morning, there's nothing new. You don't feel like you have to, but I'll be there.
But so I'll be able to look back what you just did.
I am going to email you this file.
Wonderful.
Okay.
Thank you so much for your help. I so appreciate it.
No problem. Have a good night.
Thank you. You too.
Good night, Donna.
Night.
Bye-bye.
Bye.